For professional, knowledgeable real estate service you can count on, call the Dan Gemus Real Estate Team for solid real estate information and advice you can trust. Listen to the Dan Gemus Real Estate Show.
Compliments to the show. You're really hitting on the subjects and you're telling the truth. I appreciate you.
Now back to the show with broker owner and host, Dan Gemus.
Okay, everyone, welcome back to the Dan Gemus Real Estate Show. Joyce Blackbeard in studio with me today. And next up, our guest, Ron Bondy from the Super Mortgage Team. Hey, Ron, how are you?
Fantastic. Yourself?
Very good, thank you. We're having a great show here on this Saturday afternoon. Now, a good topic today, actually, Ron. You have basically talking about insured versus conventional mortgages. This is something that many people don't necessarily understand or realize that there is a difference there.
No, and there is a huge difference and a huge cost difference as well.
No doubt.
Yes. So basically, insured mortgages is when you put less than 20% down. And what is an insured mortgage? Right. Insured is you get a better rate. There is an insurer that backs the mortgage so that if something were to happen, the lender gets paid regardless. So they get their money back.
Yes.
So they're able to offer a better rate because the risk is a lot lower. But what does it cost you for that mortgage, for that insurance, is to get that cheaper rate?
Yeah.
So typically it's going to cost you at least about $10,000. Now there are different stages to insured mortgages. So if you put 5% down, then you're paying a 4% premium. And so basically, if you put 5% down, you're paying a 4% premium. You really are only left with 1% equity in your house.
Oof.
It doesn't sound all that great.
It does not. No.
No. So you're paying for that better rate. Now, if you put 10% down, then your premium is 3.1. So now you're at about 1.9 equity in your house. If you put 15% down, your premium is around 2.8. So a little better, not much. Then once you hit that magical 20% down, then you have no insured rate. Now, because it's not insured, there is a little bit more risk for the lender, and they price in that risk. So you're going to get, your rate isn't going to be as good as an insured mortgage.
Now, Ron, by the time all is said and done, what do you typically see as the difference financially for a home buyer for a conventional versus insured rate, assuming they just put 5% down, for example? Does it make a big difference?
So, well, of course it makes a big difference because compared to putting 5% down and by the time they add the premium on, you're really only putting 1% down, right? But if you're putting 20% down, that could be 80.
Let me ask that question a different way. So you mentioned there's a rate difference typically by the lender, assuming the mortgage is insured or not insured. What's the difference typically?
So typically it is about approximately like 0.5 difference, half a percent.
It's a good chunk.
It's a good chunk, but I get asked every time, well, how about I put 19% down and that way, I pay the less premium and get the better rate. So when you work out the numbers, the better rate still doesn't outweigh that premium that you're paying. So you're still going to be paying probably $8,000 in premium, and the difference in the rate over 5 years, you're looking at, probably about $2,000.
Okay.
So it really doesn't outweigh paying the premium to get the better rate. But a lot of people do question that. Everybody tries to get inventive.
Sure.
And don't blame them for that because with the house prices the way they are, let's get inventive, right? But it doesn't make sense. And once that premium's on your mortgage, it's on there for 25 years, right? So you're paying interest on that insured premium for the whole time you have that mortgage. So not just the 5 years, right? So you got to also calculate that in. And those numbers I just gave doesn't even calculate that in. So it's even worse.
Now, next question coming in here is how does the buyer pay that premium? It's not added to the down payment. It's just slapped onto the actual mortgage amount.
Right, exactly. It's just slapped right on top of the mortgage, and then you're paying compound interest on
Yay.
that insured premium. Yep, for the length you have that mortgage. And then if you sell that house, well, then you have to pay off the insured premium and pay off your mortgage.
Oh,
so,
boy.
yeah. So,
long
it's
story short,
definitely,
you always want to have your 20% down if you can.
if you can, but let's be honest, it's a necessary evil.
Many people can't right now.
With house prices the way they are, we see most people are doing less than 20% because
sure, it's so expensive.
In order to, where the house prices are today, like a 20% down payment is quite costly, where 5% is easier to
sure.
save up for.
I guess if you have a homeowner that's been in the market since pre-COVID when the prices were lower and they've got their equity with them, so they're moving that equity to the next house. So obviously they'll oftentimes have 20% down, but those first-time buyers, it'd be rare for sure.
Yeah. First-time buyers definitely are necessary evil, 5% down. When somebody's moving houses or we call it upgrading their house, or downgrading, either or, they tend to have at least 20% down.
Sure.
So, that's a big help, and that helps them, save on their mortgage payment because their mortgage is quite a bit lower. No doubt. Putting the 20% down.
No doubt. Yeah. Now, before I let you go, Ron, what are you seeing in the mortgage world right now? Rates, how are they? Are they increasing? Has anything happened since the U.S. election?
So, with the U.S. election, bond rates have gone up, which means fixed rates have gone up.
Oh.
So, fixed rates have gone up twice since the election, which
great.
Is not great.
No, not great at all. Yeah.
But the Bank of Canada rate is coming down, which is some good relief for our variable clients, and which actually, since the last rate drop in November, has put the variable back into play, especially with the fixed rates going up. Now, is that election driven or just season driven? Could be both. So I still think come the spring market, we're going to see the fixed rates come down as well anyways.
So what are we seeing for approximate for a 5-year mortgage right now? What do you, I guess, insured?
So insured would be low 4s.
Okay.
Uninsured would be mid 4s.
Okay.
So still not bad.
No,
still not bad.
Sure. Okay.
Everybody likes to be in a 3.
Yes.
And we always tell people, hey, if you're in the 3%, you're doing well. So, I believe we'll probably get there by next spring.
Think so?
Well, I hope so.
Okay. Well, Ron hopes so. You heard it here, folks. Ron Bondy hopes that you're in the 3% range.
I am praying to my crystal ball and just say, hey, crystal ball, don't do me dirty.
Don't do him dirty. Oh my goodness! Yeah. All right, Ron. Listen, if anyone has questions for you, they want to get a pre-approval, what's the best way to reach out to you?
You can reach me by cell phone 519-791-2961, or you can email me at ronbondy@supermortgageteam.ca, or they can get in touch with one of your lovely agents.
Fantastic, Ron. Thanks as always, and we'll chat soon.
Thanks, Dan. Have a good day.
You too. That's Ron Bondy with the Super Mortgage Team. Always some great advice there. And you heard his crystal ball is predicting, is hoping. I should say it's hoping. It's hoping. Right, Ron? Yeah, it's not predicting. It's hoping. Hoping.
Yeah, hoping.
Hoping that somewhere in the 3% range, the threes. He'll say the threes by next spring next year. So we'll see what happens. All right, lots more to come right here on the Dan Gemus Real Estate Show.